Before every flight, I sit in the left seat. I run through the checklist. I look at everything, not just the instruments reading in the green, because the ones showing a problem, those are the ones that matter most. Investing works exactly the same way. This is Captain Pierce. Welcome back to SkiesCapital. Think clearly, invest better. Today is day 5 of a 30-day series, and we are talking about the most important habits long-term investors can build. And one of the most overlooked, the bulls and the bears. I'm not talking about the markets. I'm not talking about headline news. I mean discipline of building both sides of the investment argument before you put your hard-earned dollars to work. I know I have made the mistake of falling in love with the stock, writing a great bull case in my head, and completely glossing over the risk. Most investors have, and most investors have paid for it, including me. Today, we're going to fix that. Let's go. So what exactly are we talking about here? For every investment, every single one, there are 2 honest arguments you can make. The bull case is the argument of why this business deserves your capital. It focuses on what the company is doing well, where the competitive edge is, and what could drive earnings and free cash flow higher over multiple year horizon. The bear case, honest accounting of everything that could go wrong, the risks that are real and specific, the reasons the thesis might not work, competition, debt, valuation, management execution, whatever applies. Charlie Munger was famous for this in his inversion. He would reverse engineer a company, figure out what could go wrong with it before he would invest in it. The key word here is both. A disciplined investor does not just build the bull case and not at the bear case. They build both with equal amount of effort before they decide whether this investment deserves their hard-earned capital. Think of it this way. In the cockpit, we have a concept called crew resource management. Before we even push from the gate to start our flight, my first officer and I have already discussed and made a plan for what could go wrong on the takeoff. So we both know what will happen in advance if we lose an engine on takeoff. When an investor only looks at the upside, they are not a disciplined investor. Now let's talk about what actually matters in practice. 4 reasons. Number 1, flight plan discipline. A good pilot checks every instrument before takeoff, not just the ones reading in the green. Disciplined investors review the bull case and the bear case before committing their capital. Skipping one is like flying with your instruments covered. Number 2, better risk-reward thinking. When you understand the bear case, you price risk correctly. A stock can look very attractive on the surface until you work through what actually is working against it. The bear case sharpens your thinking about what you are really paying for. Number 3, prevents confirmation bias. This one is personal for me. Most investors, myself included, naturally seek out information that confirms what you already believe. Once you like a stock, you start to find reasons to like it more. Building a bear case forces you to challenge your own assumptions before the market does it for you. And the market is not gentle about it. Believe me. Number 4, clear thesis monitoring. Here's where it pays off over time. When you define both sides up front, you know exactly what to watch. Is the bull case taking strength? Is the bear case taking hold? You are not guessing, you are monitoring. And that is how you make a rational decision about what to do, whether you're going to hold, whether you're going to buy more, or whether you're going to get out. Every time I sit down to analyze a new position or review an existing one, I work through 4 questions. This is the checklist. And rather than keep this abstract, let's run through it on a real company. Microsoft, MSFT, one of the most widely held stocks in the world, and a perfect example of why both sides of the argument still matter, even on a business most people think they already know and understand. Question 1, the bull case. What does this company do well? Where is the competitive edge? What could drive earnings, free cash flow, and shareholder value higher over the next 3 to 5 or 10 years? For Microsoft, the bull case is easy. Generates $3 billion in annual revenue, growing at 17% year over year. The Azure, their cloud platform, grew 40% last year. Cloud business as a whole crossed $50 billion in revenue in a single quarter for the first time in the company's history. Free cash flow over the trailing 12 months is over $77 billion. Operating margins are running at above 46%. Return on investment capital is nearing 29%. AI angle with Copilot embedded in Office 365, Teams, Dynamics, Azure, plus a direct relationship with OpenAI, and valuation and margin of safety. Free cash flow yield at 2.73%, up 14% above the 5-year average. Trailing PE 23 times, 30% 30% below the 5-year average. The PEG ratio at 0.83 times, that's 65% below the 5-year average. And the dividend yield at 0.94%, which is 12% above its average. The moat is real. Switching cost in enterprise software is enormous. Customers do not leave Microsoft's ecosystem easily. That is the bull case. Durable in business, growing revenues, massive free cash flow, real AI monetization, and valuations that looks more reasonable today than they have in years. Now, question number 2. What is the bear case? What risk is real and specific? What could prevent the thesis from working? Here is where the discipline comes in, because Microsoft is a beloved stock, and it's easy to skip this step when you're in love with the business like I am. Capital expenditures on Microsoft nearly doubled year over year, spending over $83 billion in the last 12 months, building out AI infrastructure. Enormous bet on future AI demand. If enterprise AI adoption is slower than expected, or if competitor platforms capture a larger share of the workload, that level of investment could weigh on free cash flow for years without a return to justify it. Azure, and I am butchering that name, I apologize folks, growth has been the story driving the stock. If that growth decelerates meaningfully, valuation risk is real here too. Yes, 23 times earnings looks reasonable relative to its history, but forward earnings have to hold. If the earnings growth disappoints, that multiple will re-rate quickly. The bear case is not that Microsoft is a bad business. It is a great deal of future growth being funded today with massive capital expenditures. The return on investment is not yet visible in the numbers. Question 3. Which side is stronger right now? Weigh the evidence honestly, not emotionally. For Microsoft, the bull case is strong, but it is not without real conditions attached to it. The business quality is generally excellent. The numbers aren't in the story, they are in the financials. The moat is durable. AI positioning is real and accelerating. The valuation relative to history and to growth rate is more reasonable today than it has been in years. But the bear case deserves respect. The capital expenditure is real and large. The dependence on continued Azure acceleration is real. Anyone owning this position needs to be watching those metrics closely, not just celebrating the headline news about revenue beats. Honest verdict, bull case supports that by the evidence. Bear case is legitimate risk worth monitoring. That is the reasonable setup for a long-term investor, but only if you go in with both eyes open. Question 4, what would change your view? This is the most skipped by investors and is the most important. For Microsoft, define it clearly before you own it. The bull case weakens if Azure growth decelerates sharply without a clear explanation. It weakens if AI monetization, Copilot seat growth, and Azure AI workloads stall out despite massive capital investments. It weakens if free cash flow starts getting squeezed by capital expenditures without a recovery path in sight. The bull case strengthens if Azure reaccelerates, if the Copilot adoption continues at the pace we saw last quarter, which was 160% growth rate year over year, and if operating margins hold or expand even with heavy investments. Know these signals before you buy. Write them down, because when rough air arrives, and with any stock it will, you need a rational checklist to work through, not an emotional reaction to the stock price. That is discipline. That is a pre-flight checklist. Now let's talk about what to watch out for. 4 red flags in the bull versus bears analysis. Red flag number 1. Bull case is all story, no numbers. If the bull case relies entirely on narrative, great management, exciting product, massive market, without free cash flow, margins, return on capital to back it up, that's a yellow caution light, not a green light. Strong stories without strong numbers are non-investing theses. They are hope. Red flag number 2, the bear case gets dismissed without a real answer. Yes, but is one of the most dangerous phrases in investing. If every concern gets brushed aside, yes, but the management team is incredible. Yes, but the market is huge. The investor is not thinking. They are hoping. The bear case deserves a real answer, not a wave of a hand. Red flag number 3, Valuation is missing from the bull case. Even a great business can be a poor investment if the price is wrong. I've seen investors own a world-class companies and still lose money for years because they paid too much. A bull case that ignores valuation is incomplete by definition. Always ask, what am I paying for this? And does the price make sense given the quality and the risk? Red flag number 4, only one side is getting serious analysis. If you find yourself writing 3 detailed paragraphs on the bull case and 1 thorough sentence on the bear case, or reverse, stop. One-sided analysis leads to one-sided mistakes. Both sides deserve honest, rigorous attention every time. Here's what it looks like when you're doing it right. 4 good signs. Good sign number 1, you can clearly state both sides in plain English. If you can sit down right now and articulate the bull case and the bear case on a stock you own without reading from notes in plain English, you understand that investment well enough to make a disciplined decision. If you cannot, you have more work to do. Good sign number 2, the bull case is backed by real evidence. Strong thesis built on numbers, not narrative. Growing free cash flow, improving margins, a durable competitive position, a sound balance sheet, those are evidence. A compelling story and an exciting product are not evidence. They are starting points. Push past the story into the numbers. Good sign number 3, know what would break the thesis before you buy it. The best investors I have studied define their exit conditions before they enter the position. They know what would weaken the bull case and then they watch for it. That is what keeps you rational and honest with yourself when the stock drops 15% and you're being tested. Good sign number 4, valuation is part of your bull case. A complete bull case always includes price. If the stock offers an attractive margin of safety relative to its quality, its durability, and risk profile, that is a signal you are approaching this decision with rational discipline. You're not just buying a good business, you're buying a good business at a sensible price. That decision matters enormously over time. Favorite quote from Warren Buffett: it is much better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price. Here's the bottom line. Every decision deserves both sides of the argument. The bull case tells you what the business can become. The bear case tells you what could prevent that, and neither side is optional. It is about being honest with the evidence and with the numbers and with yourself. In the cockpit, we never take off looking at half the instruments. We look at all of them, and the ones that are showing problems get the most attention because that's where the risk lives. Your portfolio deserves the same discipline. This has been Captain Pierce with SkiesCapital. Think clearly, invest better.